In this edition of GAAP Chats, we'll take a closer look at Step 1 of the new Revenue Recognition Standard, ASC Topic 606, Revenue from Contracts with Customers. The core principle of ASC Topic 606 is that an entity recognizes revenue to depict the transfer of promised goods or services to a customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. In producing the new standard, the FASB and ISB wanted a model that could be applied consistently across various transactions, industries, and capital markets. As such, entities will now apply the new 5-step model to determine when to recognize revenue and at what amount. In this presentation, we will focus on the first step of the new model, that is, identifying the contract or contracts with a customer. It should be noted that Step 1 does not differ significantly from current practice for companies following U.S. GAAP. However, there are some nuances within the new guidance, and that's what we'll cover in this module. So, what is a contract? According to the glossary within Topic 606, a contract is an agreement between two or more parties that creates enforceable rights and obligations. A contract with a customer is in the scope of the new standard when it is legally enforceable and certain criteria are met. Whether or not these rights or obligations are enforceable is a matter of law. It is important to note that contracts do not necessarily need to be written. Contracts can also be oral or implied by an entity's customary business practices. The practices and processes for establishing contracts with customers vary across legal jurisdictions, industries, and entities. Therefore, when implementing the new revenue standard, it is important that companies get their legal department involved to ensure the agreement is legally enforceable in the relevant jurisdictions. Contracts entered into at or near the same time with the same customer are combined and treated as a single contract when at least one of the criteria listed on the slide are met. Please take a moment to review the criteria listed on the slide. An entity shall account for a contract with a customer within the scope of Topic 606 only when all of the following criteria are met. The parties to the contract have approved the contract and are committed to perform their respective obligations. The entity can identify each party's rights regarding the goods or services to be transferred. The entity can identify the payment terms for the goods or services to be transferred. The contract has commercial substance. It is probable that the entity will collect substantially all of the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. If a contract with a customer does not meet all of these criteria, an entity shall continue to assess the contract to determine whether these criteria are subsequently met. When a contract with a customer does not meet the previously discussed criteria, but an entity receives consideration from the customer, the entity shall recognize that consideration received as a liability. This consideration is recognized as revenue only when the criteria are subsequently met or substantially all of the consideration received is non-refundable and one or more of the following events have occurred. The entity has no remaining obligations to transfer goods or services to the customer. The contract has been terminated, or the entity has transferred control of the goods or services to which the consideration that has been received relates. The entity has stopped transferring goods or services to the customer and has no further obligation under the contract to transfer additional goods or services. Let's take a look at an example to put what we've learned about Step 1 into practice. Metroman produces and sells custom leather man bags. Metroman receives a large order on December 15th from Polly's Purses, an existing customer in good standing. Metroman's normal and customary business practices for such transactions is to receive a written sales agreement from the customer that requires the signatures of authorized company representatives and approval from their respective sales committees. Authorized representatives from both Metroman and Polly's have signed the agreement. However, the sales committee for Polly's is currently on a mancation and will not be able to formally approve the order and sign the agreement until January. However, they did verbally approve the contract on a phone call. Due to the size of the order and their existing relationship with Polly's, Metroman decides to ship the man bags the last week in December. The man bags arrive at Polly's prior to year-end December 31st. Can Metroman recognize revenue at December 31st, as it is highly unlikely that Polly's sales committee will not approve the order? We'll look at the solution both under the old guidance and the new guidance in accordance with Topic 606. SAB 104 requires persuasive evidence of an arrangement to exist in order to recognize revenue. According to the SEC, persuasive evidence of a sale represents the agreement of the sale. Without it, delivery means nothing in terms of transferring the risks and rewards of the sold item. If a written contract is considered evidence of normal business practice, all criteria are not met until signed by both parties. Whatever is determined to be persuasive evidence should be applied consistently for all transactions of the same kind within a company. Oral agreements typically are not acceptable, and delivery cannot be used as a substitute. The agreement either exists in its final form or it does not. With Topic 606, the definition of a contract emphasizes that a contract exists when an agreement between two or more parties creates enforceable rights and obligations between those parties. Note that the agreement does not need to be in writing to be a contract. Whether the agreed upon terms are written, oral, or are otherwise evident, a contract exists if the agreement creates rights and obligations that are legally enforceable against the parties. We hope this presentation has helped you better understand Step 1 of the new 5-step model. As always, contact us with any questions you have on the application of US GAAP or IFRS. This presentation has been brought to you by GAAP Dynamics.